If I told you that one tiny company could be about to change the energy industry forever and that it's trading for just $1, would you be intrigued? This little-known Aussie company says it's found a way to transform fossil fuels into clean energy. Think about that for a second. That's huge. Currently, this company is so small that hardly anyone knows about it, which is why its stock is still so cheap. And that means there's the potential for incredible returns if and when this company's tech goes mainstream. This clean energy breakthrough stock is just one of 7 promising Aussie companies on our radar at the moment. To get the full details on all of them, click the link below now.
G'day there, welcome to the week ahead with Pivot Trader on the 11th of October. Today I'm going to really focus in on the US 10-year bond yield chart. I think it's the most important chart out there, or market out there at the moment, because it is just on the edge of potentially really having quite a sharp spike in yields. So I just wanted to explain it to you very quickly, how I'm seeing things. And that will inform really what happens to equities going forward as well. We know we're heading towards taper in a month or two, so they're going to be lowering the amount of assets they're buying, so that can put upward pressure on yields. We have inflation already very high, so real yields are negative, but inflation is heading higher with gas and oil and coal prices going through the roof as we head into winter. Europe and Asia fighting over LNG supplies, rolling blackouts across China and India. We are approaching a time when things could really see these yields spike beyond what people expect. So this chart here being the US 10-year bond yield chart, I think it's a great case study of what I look at. Just to give you a sense of the chart and the big picture, what we're looking at here is decades of interest rates falling, and it feels like it is just relentless, and that downtrend is completely intact. You can see there this channel that we've been in for decades, and nothing really saying that that channel is finished, is it? But we're just in a period where I think we could see a test of that channel at some point. The 10-year yield needs to go a long way to threaten the overall downtrend for the past few decades. So it needs to actually crack above 3 to be heading above the lowest high in the downtrend. So as this trend develops, we're looking at these levels as it heads down for areas where we think the trend could be under threat. And really, it's never been under threat, and it's a long way from threatening that multi-decade downtrend. But that doesn't mean rates won't rise in the meantime. And just looking up close, the price action for the past decade has really been forming what I call that range distribution, of price, where you have this initial wave higher in yields back in 2012 to 2014, and really the rest of the price action since has been related to that. And the fulcrum of that range is around 2.2%. So that's the first major point. The POC, or point of control, of over a decade of trading in those US 10-year yields is around 2.2%, which is quite far above where we are now. And really how I look at these things is once we get this range set up, I tell you about the areas within the range, the buy and sell zones, which is where I expect to see potential reversals in price, as we saw back here. And even here, got up to the sell zone, went back to the point of control. So what I'm looking at when I'm giving you these lines outside the range, I'm also showing you areas where I expect reversals can occur, or there's a higher probability you'll see a reversal near that 25% zone, and prices can head back to the point of control. And also down at that 618 level outside. So the Fibonacci outside the range is very important. That's a point where it can still actually be under the influence of that point of control at 2.2%, but it looks like it's not. It looks like it's completely gone. So when the yield plummeted like that, people aren't considering the fact that it is actually heading to a support zone outside that upper range where it had been in for the last decade. But you can see what happened. Headed down there, hit that support zone, and is bouncing back. So this is the major point, is that we're still under the influence of this range of the past decade with that point of control at 2.2%. So zeroing in on the shorter term, we can see that the 10-period exponential has crossed above that 20-period simple. So the long-term trend from a moving average perspective is saying yields are going up. If we're just looking at the buy and sell pivots, just a simple analysis of them, is that on the monthly chart, we had the monthly buy pivot back there. So you can see the real spike in yields that happened towards the end of last year and the start of this year. It then turned down to find support, and we did actually create the monthly sell pivot, but then last month created the monthly buy pivot on those yields. So everything pointing up for yields right now. And really, if it busts back above that high in the move from a few months ago, around 1.8%, I think it's 1.78 or something like that, 1.77%, it really sets off a chain reaction that can take yields quite quickly towards that point of control, which is the fulcrum of really a decade of trading. So that's sort of where we're at right now, with yields starting to spike as we head towards taper. Now, I really do need to see it breaking out above that 1.78 region. It started on Monday at 1.61% after a bad week last week. So we were only 20 bips away, but that can take a long time in those bonds. But boy, if it does start accelerating this week and we bust out above there soon, I'm just concerned that you're going to see a real move in those bonds to 2.2%. So that's why my ears are really pricked up that that is what our future could be. So moving on to the S&P 500, just wanted to reiterate really what I said last week, which is that it's all still trending up. Of course, this is the weekly chart for you, and I was just concerned about the short-term downtrend, but that can all flip positive very quickly. This whole trend to the upside has seen many periods where you get a few weeks of weakness, or even a month or two, before turning back up and taking off for another wave higher. And we could be definitely at that point where things can look fantastic again very quickly. But you don't want to jump the gun in a situation like this, I guess, where we have already had the weekly sell pivot there. So the first signs things might be turning down. First weekly key bar there with a weekly close below the low of the sell pivot candle. We've got another weekly key bar here, which again, we get the weekly close below the low of that first key bar. That's just the sense that things are stepping down here. So if I'm just looking at that week's range, which was a wide range, and we think about where we should expect buying and selling pressure, last week's range was showing us that, the buy zone of that range is seeing buying pressure, the sell zone of the range seeing selling pressure. So it's caught between a rock and a hard place here. And really where it breaks out of that last week's range is going to be telling. So I need to see a weekly close above the high of that range. That will create the weekly buy pivot within a long-term uptrend. Could look fantastic and be super bullish. Alternatively, US 10-year bond yields crash through 1.8% and start heading to 2%. Potentially, we are going to see an extension to the downside. So breaking out below the low of that last week's range, or 2 weeks ago range, could see a bit of a panic selling, which still has lots of support down below there. But I'm just pointing out how this thing can develop. Not out of the woods yet, and really need a weekly close above 44.72 in the S&P 500 futures for me to just say yes, everything looks fabulous. And obviously with gold, if the US rates are going to spike higher, it could see gold under pressure if real rates start to head up. And I'm still of the view, under that 1680 level, you've just got to watch out for a bit of a clear out of positions. Don't know how far it'll go, but I think that could end up creating a great buying opportunity. But I just want you to be aware of that fact, that it could have a bit of a clear out and the gold stocks could come under pressure in that case. So just got to tread a bit carefully in those gold stocks as far as I'm concerned. And really a similar story that I've been saying in oil, saying that it can continue on. I've got targets back to that October 2018 high in Brent, and that's up around 87, and that's similar to the Goldman Sachs saying it could be heading to 90. So it's trending nicely. The monthly strong, holding above the 10-month exponential, finding support. It's all marching higher nicely. It should have a bit of a lunge for the line late in the year, but that could bring the selling in, creating a bit of a false break of that high, and then back to support, and could ultimately be a nice long uptrend towards $100 happening, depending on how this crisis unfolds. But everything looking quite strong in oil, and even some of the commodities having not a bad finish to the week, turning up. Lead looking all right. Also zinc turning back up, heading towards the highs. Nickel up very strong. I really am interested in nickel, what's going to happen above these highs. It's been flirting with it and struggling to carry on with it. But I think one of these days, nickel is just going to trend up quite strongly from here. So all looking quite good there. So really, that's it for today. I think the big story is those US bonds. Keep an eye on those. I think if they start spiking further to the upside in yield, then I think equities will sit up and take notice. And Evergrande possibly going to miss another debt payment today. So I think they are due to make another bond payment today. So we'll see whether that news flares up its head again. All right, cheers. I'll come back with more next week.